How's everybody doing today? As you know, we have a limited amount of time, so I'm going to go ahead and get started with the main part of the presentation. As Reed talked about, we're going to focus on how to make profits with explosive moves on stocks, but we don't really care what direction the market goes, and boy, isn't that important with where we've been in the market over the last few trading days. So the timeliness of this presentation couldn't be any better. We don't have to have this kind of volatility, but we love this kind of volatility in the markets, and when it's going up, going down, we don't know which way it's going. Absolutely perfect for this type of a presentation. So with that, we'll go ahead and move forward. I really have no idea what the savviness is of this audience. I know that you're pretty savvy as far as investing in general, but from an option standpoint, so forgive me if you know about options. I'm going to assume that you don't know very much and that we're going to be starting at square one. You see the presentation, it's axiom strangles. As Reed mentioned, this is a twist. Now, if you're familiar with options, you might be thinking, oh my goodness, you're going to bore us for 45 minutes on strangles. What a boring strategy, but I promise you two things. One, we have a killer presentation, so the graphics are worth staying and watching anyway. But this is a twist on strangles. I don't like to say it's proprietary because I don't know that for sure. I don't know the entire history of the world of options, but I haven't seen it anywhere else. So as far as I know, this is something that I created myself. But again, I don't want to boast that without 100% proof. It is unique, I will tell you that. That much I am aware of. And it is not based on a just basic traditional strangle. We do have a twist, again, as Reed mentioned. So with that, let's go ahead and move forward. So what you're going to learn is how to profit without forecasting market direction. We will compare straddles with strangles. Most everybody, even if you're not very savvy in the world of options, has heard of a straddle. You buy a call, you buy a put. Call makes money, the stock goes up. Put makes money, the stock goes down. You don't care what direction. But there's some issues with dealing with straddles. Strangles are less expensive, but there's some issues dealing with strangles as well. But we've come up with something that alleviates the issues. And how did we do that? Greeks. If you're going to trade options, you better understand the Greeks because that's the key, and I can assure you the floor traders understand them. So we'll go through and explain the Greeks that we utilize here, how we utilize them, and why they help make this such a unique strategy. Then also we need to talk about the patterns. There are very specific patterns that we look for in order to identify these opportunities. And if you don't find these patterns, then you could be dealing with a stock that's just moving sideways, and then the strategy won't work very well. So very specific patterns. We'll highlight those for you. And then how to find them early, before the stock moves. We're going to identify a stock that's getting ready to move, but we want to find one that's hasn't moved yet and getting ready to. So we want to get into the position early. So I haven't piqued your interest enough yet. Here is our performance. This is an equity curve. As Reed mentioned, I've been doing this for a long time. As a financial advisor, I'm going to give you a couple minutes of my history here in a second. Back in the mid-90s, and I have a select few clients that have stayed with me since then. And then I started doing this alert service several years ago for somebody else, and then I started thinking, well, that's crazy. Why not do it for myself? And Option Axiom was born. And you can see we started in January of 2012, and that's the equity curve just based on strangles. Now, we do other strategies. We have other subscriptions, but this is highlighted on just strangles. So I think anybody would agree it's pretty impressive and certainly outperforming the S&P over that time frame. Now, as anybody, when you go through a process of learning in the educational world, you attend a lot of seminars, you attend webinars like this. When I first started, there wasn't such a thing as a webinar, but those things have made it so much more convenient for a greater number of people to learn. But I always wanted to know when I attended a seminar, what qualified that person to be in front of the room? Why was I spending my hard-earned money to listen to what they had to say? So if you bear with me for just 2 minutes, I'll give you a little bit of my background, and then we'll move on to the important stuff, which is really what you are most interested in. I was a former golf professional. I guess I am a former golf professional. I was a PGA pro for nearly 13 years, and a lot of people see that and they go, why former? Why would you ever leave that career? Well, I wasn't a tour player. I did qualify and play in a few events, but I was a club professional. And if you play golf, you know the busiest times at any golf course are weekends and holidays. For nearly 13 years, I never had a weekend or a holiday off. And when you have a family, that makes it very difficult on doing other things with the family. So I knew there was something else that I wanted to do in life, and how money worked always really interested me. So I moved into the financial services world in the mid-90s, started working for a proprietary firm, a captive firm, if you will, and realized that, boy, I just didn't really like having a boss. So I started my own financial services business in 1996, and by 2000 I was in the millennial edition of Who's Who in the world of financial advisors, so progressed pretty quickly. And through that progression, I came in contact with a gentleman that owns the Florida School of Insurance, and for whatever reason he really liked me and liked the way I taught. And so I started teaching the securities licensing class for those that wanted to become securities licensed in the state of Florida. We taught a class in Miami, Tampa, and Orlando, 3 major cities. So that's when I discovered that, boy, I really liked spreading this and being able to give my twist on things and educating others on what I was doing. So I became an independent speaker, independent contractor in the speaking world, and was fortunate to literally travel the world for, again, over 12 years, same kind of time frame as I was in the golf business. I guess after 12 years I started to get that itch or whatever, educating people in the world of trading options. I left the financial services world because I was dismayed. Again, Reed gave you that. You sat down with a potential client and everything was based on fundamentals, and you gave them these wonderful pie charts on dividing their assets across several different asset classes, but I learned that, boy, it didn't matter how great an asset allocation plan you had. If the market went down, they still lost money, and I thought there had to be something better. I discovered options on my own, attended my own seminars, and then much to my dismay, the world of brokers, relationships, broker-dealers, they don't want you to trade options for your clients, and they definitely don't want you doing it yourself either. And I just thought, that's crazy, that's ridiculous, and that's when I started educating on my own. So I've been doing this alert service where I identify the opportunities and allow others to take it for what they will for nearly 6 years, and then over the last few years decided I just wanted to do it for myself. Pretty quickly realized, again, didn't want to be connected with anybody else. It gives you a brief history of how I came to be talking in front of you today. So again, I'm going to assume you don't know a lot about options. If you buy a call option, it's known as a long call. Call and buy are synonymous. You can see we have a risk graph that's on your screen. Over on the right-hand side is your profit loss. Down at the bottom, the horizontal axis there is the movement of the stock or whatever security you're trading. As long as it's optionable, you can place this on anything that's optionable. It doesn't necessarily have to be a stock. But when you're long a call, that means you're going to profit if the individual security that you have options on moves to the upside. The zero line there is known as break even. So we see where that zero is with the dollar sign, that's your break even point. Anything above that, you're making money. If it goes the other way, and we know we're not always right, you're losing money. But the beauty of options is if you're buying the options, you're limiting your risk. You can never lose more than what you paid for the option. You can make infinite amount of money to the upside. There's no limitation when you buy a call to how much you can make to the upside, but you are limiting the downside if you're wrong. And again, with a market that's starting to create more volatility like we have now, you want to be able to limit those losses. Well, if we flip the coin here and we want to be able to profit from the downside, that was what really interested me about options initially, was the fact that here's a way I can not only protect myself to the downside, but I can profit from the downside. And again, I was so frustrated that broker-dealers wouldn't allow you to do that for clients in the traditional financial advisory world. Now, how crazy is that? It makes no sense at all. Here's a way you can protect your clients if things go down, and they don't allow you to do it. Just extremely frustrating. So again, why I have option axiom. With long puts, you profit to the downside. If the security that you have options on moves to the downside, you make money. We have the same looking risk graph here, but now we have the profit loss on the left side, the vertical axis, and the horizontal axis down at the bottom, the movement of the share price itself on the horizontal axis. So if it moves to the downside, you're making money. If it moves to the upside, limited risk. Now obviously when you're buying puts, stock can't go to zero. There is a tremendous amount of support at zero. Can't go below zero. So I always talk about the fact when you're buying calls, you have unlimited profit potential, but when you're buying puts, you have substantial profit potential. It's not unlimited because it can't go below zero. But you still have limited risk if you're wrong and it moves to the upside. So just the simple act of buying options allows you to profit on a directional movement of the stock with limited risk. Well, what if we don't know what direction the stock's going to go? What if we can't figure that out? Well, that's when we start looking at combining options and creating strategies. So here's our risk graph again. Over on the left-hand side, the vertical axis is representing profit loss. The dotted line in the middle is your zero or break-even line. So anything above that dotted line is profit or potential gain. Anything below it is risk or potential loss. So we're trying to make it as easy as we can by color coding this. So if it goes above the dotted line, that's green, that's good, you're making money. Below it is red, that's bad, you're losing money. So there was that risk graph of the long call. Let's add in the risk graph of the long put. So now we're combining the two. So we just talked about a call, we talked about a put. Call lets you make money if the stock's going up, put lets you make money if the stock's going down. Let's put the two together. So if we combine the two together, now we have this risk graph, which is the risk graph of a straddle. The beauty of a straddle, it doesn't matter what direction the stock moves. If it moves to the upside, you're making money. If it moves to the downside, you're making money. What does that mean? You can't lose? No. See the red V there? That's where the risk is. So what's the risk? The risk is it doesn't move. If it just sits there and doesn't move, now you have risk, and the risk is time decay. Every day it goes by, every day that goes by and it doesn't move, you're losing money. So you need the stock to move. But you may also notice that if we start where the point of that V is and then go up to the zero or break-even line, wow, it looks like the stock has to move a lot to the upside before the call starts making money, or it looks like it needs to move a lot to the downside before the put starts making money. Well, remember, risk graphs are drawn at a finite point, and most risk graphs are drawn at expiration of the options. Options don't last forever. They do expire. At some point they go away. They're not infinite. So the time value is a fee that you pay within the option premium for the amount of time that you have the privilege of owning the option, but you have great leverage. Small amounts of money allowing you to generate large profits, but it has to move. Now, if you're fortunate enough to put on a position and it moves quickly, the dotted line is representing the very next day. So immediately if you put it on, you can see if the stock starts moving to the upside, we're making money. Stock starts moving to the downside, we're making money right away. We don't have to wait. But that's if it moves immediately, and they don't always move immediately, as I mentioned. So the straddle has its pluses, but it has its minuses as well. You're buying an at-the-money call, you're buying an at-the-money put. So if a stock was trading at 100, the 100 strike call is at the money, the 100 strike put is at the money. It's expensive, as you're going to see when I go through some examples. So there has to be some way that we can improve the cost. Straddles interested me based on the fact that they were lower in cost, but they still had the same issues as far as you needed to move right away, and if we move, we have the offsetting loss of the other option that we bought, and that works against the profit. So you need a substantial move in either a straddle or the traditional strangle in order to generate a profit. But in learning the Greeks and really going through in-depth my option education, I started realizing there's a way we can allow these things to work for us. So one of the primary Greeks that we utilize in the strategy that I'm going to share with you, which we haven't talked about yet, is delta. Delta is one of the Greeks. What is it? Delta tells you how much an option will make or lose on the very next dollar the stock moves. So it's a value, and it's a percentage of the stock price, but it tells you how much the option, again, will make or lose on the very next dollar the stock moves. After that first dollar, the delta changes, and that's going to be the key of what I'm going to share with you today. That's another Greek known as gamma, and we're going to go through that in detail in a second. But let me give you an example of how delta works. Let's say that we have a stock that's trading at $20 a share. Well, to go out and buy the stock, you're going to have to pay $20 a share for the stock in a cash account. You can get it down to $10 in a margin account, but let's just stay with a cash account for an example. So stock's trading at 20. Instead of paying $20 or $10 in a margin account for the stock, we can go buy an at-the-money call option, a 20-strike call for $2. Well, there's your leverage. A lot less money to control a higher valued stock. You only have to put up $2 to control a stock's trading at $20. So obviously that's attractive. Now let's say the stock moves up. Now remember, this was an at-the-money call. So with a call, we want the stock to go up. It does. It goes from 20 to 21. And on that movement of the stock up from 20 to 21, our call option moves from $2 to $2.50. So a 50-cent rise in the option, a $1 rise in the stock. Let's do some basic math. Got a question for you. If the stock moved $1, how much of that dollar did the option receive? Well, the stock moved up $1, right? So a $1 move in a $20 stock represents a 5% move in the option. How much did the option make? Is it 25% or is it 50%? This is where people get confused sometimes with the math, because an option moving from $2 to $2.50, a 50-cent move in a $2 option, is a 25% move in the option. So already you're seeing the beauty of options. A $1 move in the stock is only a 5% move in the stock. The option moving from 2 to 250 is a 25% move in the option. There's your leverage. But the question was, how much did the option make? Well, remember, it's a percentage of the stock movement. The option moved up 50 cents. The stock moved up $1. So the option made 50% of what the stock did. So here you have this tremendous leverage. You're only putting up a small amount of money, and you made half of what the stock made. So the answer to the question is 50%. The option made 50% of what the stock moved. And that's just on the initial dollar move. That doesn't count what happens from here. We all learn differently, and you may have taken an aptitude test. I learn visually. That's the way I learn. I can read all I want, but it doesn't soak in. I need to be able to see things. You can Google the delta formula and get the mathematical formula. I took calculus in college, and I still can't figure out the mathematical formula for delta. But I can look at this picture and understand it. So this is what's known as the delta curve. In the bottom left, way down at the bottom left, that would be a 0 value for delta. Up in the upper right, that's a 100 value for delta. Delta moves from 0 to 100. Those are the values. Now what you're not seeing down in the bottom, but what I want you to picture is the horizontal axis, which again represents the movement of the stock. So you can see that it's not uniform. There's a distinct curve in there where the delta isn't moving much in the beginning, starting from 0 and moving to the right. It's not moving a whole lot there as far as a vertical move. And then we go, boom, straight vertically, and then we level off again as we approach 1 or 100 in the value of delta. Well, if you're buying a straddle, that position where you're buying a call and you're buying a put, remember I mentioned you're buying an at-the-money call and you're buying an at-the-money put, which means on the delta curve, you're buying both of those options at the point where the arrow is pointing at the actual curve, dead smack in the middle. That's where 50 is. Obviously, the bottom left is 0, the upper right is 100, so right in the middle is 50. Well, once the stock starts to move, it doesn't matter whether the stock moves up or down. Once the stock starts to move, one of your options is moving up the delta curve. It's gaining value. The other option is moving down the delta curve. It's losing value. When you look at that curve, doesn't it look like the arrow moving up and the arrow moving down are almost vertical, meaning that they're moving at the same speed, which would mean that the option that's moving up is making money at about the same speed as the option moving down is losing value. Because as the delta goes down, the option's making less and less and less of that move. As the arrow moves to the upside and the delta's going higher, the option that's moving up the delta curve is making more and more. But if the one making more is being offset with the option that's losing value at roughly the same speed, you can see that the stock has to move quite a bit before the option making money is offsetting the option losing money enough to where your position is gaining value. Therein lies the issue with a basic straddle. You know how they say you do your best thinking in the shower? I say that in seminars all the time, and I get the blankest looks back. I must be the only person that's ever heard that you do your best thinking in the shower. But there was a specific day where I was in the shower and I was thinking about this, and I was thinking about delta. And if you haven't traded options, it gets in your blood. You'll become addicted just like I have been. And you change, you get into the shower and you're thinking about options. That's how things work. But what I was thinking about is this delta curve, and I was picturing the delta curve in my mind and thinking, what if we changed the entire position? Now, when we move to a strangle, you buy an option 1 strike out of the money on the call and 1 strike out of the money on the put. I'm going to show you examples of it so you can see clearly what I'm talking about. It doesn't really change things much. But what if we made a major change? What if we moved way down here? Do you see where that little curve is in the delta curve, where all of a sudden it starts to accelerate to the upside? That's what's known as the sweet spot, the profit sweet spot, if you will. Where the delta curve starts going vertically, that means that option moving up is gaining value extremely fast. And that represents somewhere in a 25 to 35 range, with 30 being the absolute purest sweet spot. Now, you can't always find equities with options that have a delta right at 30, so we give it a little bit of a range. So anywhere from 25 to 35 is what we're looking for. 30 is ideal. If we could pick that every time, we would, but we don't have those choices. It doesn't always work out perfectly. So we have a little bit of range there. But what if we start by buying both the call and the put right in that area that's highlighted on your curve, right at the beginning of where the acceleration goes? Well, that means once the stock starts to move, and again, it doesn't matter what direction, the arrow going up does not mean the stock is moving up. That is your option gaining value based on the delta. See how that arrow is going vertically up? But the option that's losing money now, notice the difference in the angle. The option that's going down is now losing money slower. So in theory, and this is where I was in the shower, it was just nothing more than a theory at that point in time. In theory, once the stock began to move, if we bought both the options at this specific delta, the option moving towards the in the money should be making money much faster than the option losing money, which translates to the fact that you should make money faster based on this. But again, at this point, it was nothing more than a theory in my mind. Well, what do you do with theories? You put them into practice and see if they work, right? So let me give you some more visuals before we do that. Here was the graph of the straddle. It's a big V. If we widen it out into more of a U shape, that's your strangle. Well, now you can see where straddles become more popular than a basic strangle, because most people say, well, a strangle's worse. Look, the stock has to move further. It has to move further to the upside before the risk graph starts going up, or further to the downside before the risk graph starts going up. You need more of a movement out of the stock. Okay, it's going to cost less because you're buying an out-of-the-money call and an out-of-the-money put, but so what? It's costing less. You need more movement. You're still going to lose money. And because of that, nobody really thought about strangles. When I was going through my education, nobody talked about them. I heard some talk about straddles, but nobody focused on strangles, and this is the reason why. This is the first real trade that I did on this theory. Now, my nature is not to backtest too long. I'm ready to put some money at something and see if it really works. So this was the very first position that I ever put this strategy into play. Now we're going to go through these patterns. That pattern is known as a symmetrical triangle, or symmetrical wedge. And again, just keep that in the back of your mind for now. We'll go through the patterns in detail in a few minutes. But this is what we're looking for, these type of patterns. Now what that means is the stock has run up, in this case obviously Google, had a big run, and then it went through a consolidation period. You can see the pattern of lower highs and higher lows. Nice symmetrical triangle. An ideal scenario for one of these positions, and on top of that, for those candlestick fans out there, we got a doji right there near the point of the triangle. Indecision, right? Perfect opportunity to put one of these on. The stock is likely getting ready to make a move based on that indecision. Well, if you were to put on a traditional straddle, when Google was trading at $680 a share, by buying the 680 call and the 680 put, look at the debit. 70.45 for one contract of that straddle is going to cost you $7,000. $7,000 for one contract. A lot of money for one contract. If you were to do the traditional strangle, it would cost you a bit less. But if you were to do the axiom strangle, the option axiom strangle, the way we described it, or the way I just talked about at the 30 delta, look what happens to the debit. $26. For one contract, $2,600. That's still a lot, but it's nowhere near $7,000. Look at the strike prices. Now we're buying the 750 call and the 630 put. Google was trading at 680. So the call is 70 points out of the money from where the stock is trading. The put's only 50 points out of the money. With a normal strangle, you want both of those options equidistant. So you might have bought the 690 call and the 670 put, each one 10 points away. We don't care about the strike. We're not interested in the strike. We're looking for the delta. We go down the option chain looking at the delta. Where's the 30 delta? Boom, that's the call I want. Go down and look at the put side. Where's the 30 delta? Boom, that's the put I want. Don't care what the strikes are, even though they're not equidistant. 70 points out of the money on the call, 50 points out of the money on the put, $2,600. Now an average person with limited knowledge on options is going to look at that and say, are you kidding me? 120 points difference between the two strikes? Google moves a lot, but it's not going to move that much. You're crazy. Maybe you're only paying $2,600, but you're going to lose that $2,600 because Google isn't going to move that much. Well, if you know the Greeks, and you're going to understand them here in a second, you're going to find you're going to have a whole different view on how this works. So Google breaks out. The straddle makes $495 on that movement, about a 28-point movement in the stock. That's not bad, right? $7,000, you made $495, not bad at all. But look at the strangle. Now remember, you only paid $2,600 for it, and on the exact same movement of the stock, the option axiom strangle makes $590. $590, and it's only one contract. What would you rather do, pay $7,000 and make $495, or only pay $2,600 and make $590? You paid significantly less for the position and you made more. Why? Because you understand the Greeks, we understand delta, we understand gamma, we understand the acceleration of delta. And it goes right back to that delta curve. The fact that we are moving straight up the curve on the option moving in the money, and the option losing money is only losing a little, versus the straddle where they were almost exactly offsetting each other. Next day, Google moves down again. Awesome, we made more money, right? The breakout was to the downside. The put option is controlling the profit in this position. It went down again. Well, what happened? Look at the profit. We're only up $390 now. We lost $105. How is that possible? The stock went down again. How is it possible that we lost money? Volatility, something that we're going to talk about in detail here in a few minutes. You better understand implied volatility as well, because Google dropped $28 the first day, but it only dropped $8 the second day. Was it as volatile? No. Implied volatility came out, and it hurt your position because you started with at-the-money options. Look what happened with the axiom strangle. We made money. We made another $15. Well, that's not a big deal making $15, but it's better than losing 105, isn't it? Why? Because implied volatility doesn't affect the out-of-the-money options as much. Because we're well out of the money with that 30 delta, we're not as affected, still affected, but not as affected in a drop in volatility. Next day, another big move out of Google, get some volatility back. We now have our straddle at $885 of profit. Paid $7,000, made $885. Not bad. But the axiom strangle that we only paid $2,600 for makes $1,090. So you could have put up $885 or $7,000 to make $885 of profit in the straddle, 12.5% return in a few days. I don't think anybody would argue with that. It's a pretty decent profit. But with the option axiom strangle, you only had to put up $2,600 and you made $1,090. You spent less money and made more in real dollars. 41.9%. Forget the 41.9%. Who cares? What do we care about? How big our account is, right? $1,090 of profit. Where does the ROI come in? How many contracts of the strangle could you have done for one straddle? 2 or 3. Then you multiply that profit 2 or 3 times based on the same amount of money that you would have put at risk in the straddle. So that's where you have a choice. You can determine that you're going to put X number of dollars in a trade and do 1 contract of the straddle or 2 or 3 of the strangle and spend the same amount and make multipliers more. Or you can just say, I'm just going to do 1 contract and have a lot less money at risk. That's a personal choice, whatever you want to do. But isn't that amazing? On the exact same movement of the stock, you pay such an amount less and make more, spend less, make more. I don't know about you, sounds like a win-win to me. Less cost, faster profits. Pretty good stuff. Why does this work? The acceleration of the delta. All we're doing is repositioning this on the delta curve. Is it arbitrary? No, it's a mathematical formula. This is how options have to work. It's math. We're taking advantage of the math by understanding it. All right, now how do we find stocks that are getting ready to move? There are several different kind of breakout patterns. There's flag patterns, pennant patterns. Those are stocks that when they find those patterns tend to move. But my favorite are the triangles or the wedges. Why am I using that in plural? Because there's 3 different ones. This is what's known as an ascending triangle or an ascending wedge. In this pattern, the highs are the same. The stock goes up, or again, whatever security you're trading, goes up, hits a particular price level, comes back down, creates a higher low, goes back up again, but bumps its head on that same area of resistance, comes back down. But each time it hits that area of resistance and comes down, the lows get higher. So you have the same highs, but you have higher lows. Which direction do you think this stock is likely to break out? Most people say that in an ascending wedge pattern, due to the fact that you have higher lows, normally that stock is going to break through that area of resistance and eventually move to the upside. But statistics don't show that. Statistics show that it could break down just as much as to the upside. It's a breakout pattern, but don't start thinking it's going to go one way or the other. When you start becoming directional out of this, then you're changing things. We don't care what direction it goes. Now we have the opposite, a descending wedge or descending triangle. Well, here we have a stock that moves lower in price, comes down, finds an area of support, bounces up. On the bounce, it makes a lower high, comes back down towards that area of support, finds it again, bounces again. Each time it bounces off support, it makes a lower high. So we have the same lows, but lower highs. That's a descending wedge or descending triangle. Now again, you will read, most people tend to think that in a descending wedge or descending triangle, we're likely to move to the downside. Statistics don't show that. Statistics show that this could break to the upside just as much, that that area of support could act like a launch pad and you could break to the upside. Sometimes we break lower, sometimes we break higher. Again, we don't care. Now that Google example, the first actual position that I did after discovering this, is a symmetrical triangle. If I had to pick one, this is my favorite. In this pattern, we're going up and we're making a series of lower highs and higher lows. So lower highs, higher lows. It's also cooler looking, isn't it? But it's a symmetrical wedge or symmetrical triangle. Which way is this going to break? Well, most people will say, we don't know. They tend to think the ascending breaks up, the descending breaks down, the symmetrical, we don't know. But again, statistics show it's going to break up just as much as it breaks down. We don't really know. But that's my favorite one. That's my favorite pattern out of all of these. Here's another example. They don't always work perfectly, do they? Boy, that Google example did. Don't you love it when something moves that fast and you can make that kind of a profit in just a few days? It isn't realistic that they're all going to do that. Look at this example. Another symmetrical triangle here, sitting right in the middle at $60. Price is at $60. If you were to put on a regular straddle, you'd buy the 60 call, you'd buy the 60 put. It's going to cost you $8.95. If you did one contract, $895 to put on one straddle. Now, if you do the traditional strangle, now Cree had 2.5-point strikes. You didn't have to go to 5 points. You could do 2.5 points. So one strike out of the money would be buying the 62.5 strike call. One strike out of the money on the put would be the 57.5 strike put. That's your traditional normal strangle the way they're taught. One strike out of the money either side. You lowered your cost, $6.67. For one contract, $667. However, with the axiom strangle, looking for the 30 delta call and the 30 delta put, it was the 65 strike call and the 55 strike put, further out of the money. And again, most people thinking you're going so far out of the money, stock isn't going to move that far, you're not going to make money. We lowered our cost. It's $4.82. So one contract's only $482. About half of what it would cost you to do the straddle. But again, they're missing the actual math. Okay, Cree research breaks to the downside. Beautiful. Straddle's up $118. Traditional strangle's up $117. That shows you a little bit there that the traditional strangle made almost the same amount as the straddle. Well, we're going to be lagging way behind, right? Because we only paid half the money. No, almost the same, $101.50 with half the amount of money at risk. So we made almost the same amount with half the money at risk. Here's what I meant. Stocks do two things out of these patterns. They break quickly and decisively like Google did, or sometimes they break out and they come back and test the breakout before the final big move. That's exactly what Cree did. It broke down, but now it came back up. And look, we're getting back up to the point of the triangle. Well, that can't be good, and it's not. The straddle's down $200, so we're sitting at a loss. The strangle's down $204.50. Our axiom strangle down $188. Whoopee, we're losing a little bit less. Nobody likes to lose money, so nobody's happy at this point. So after testing the point of the triangle, boom, now Cree gets its act together and starts the move we were looking for. The straddle back up to profitability, up $23. Strangle still down, but only 50 cents, basically break even. Our position down $36, almost back to break even as well. Remember, we only paid half as much as the straddle. Cree continues lower. Straddle's up to $127 in profit. Strangle's up to $108. Our axiom strangle, $61. Now you're thinking, oh, hey, you're lagging behind here. Well, we keep moving. The straddle's up $294. Strangle's up $285. The axiom strangle, $241.50. Almost back to where the other two positions are at half the amount. Stock moves again. $434.50 in the straddle. That's not bad, is it? $411.50 in the strangle. Our axiom strangle, $365. And you're thinking, wow, you didn't make as much. But remember how much we have at risk. The return on investment in the straddle is 45.5%. Again, nothing to shake your head at, right? That's nothing. That's not bad at all. The strangle, 61.6%, but the axiom strangle profited 75.7%. We made more percentage-wise on less amount at risk. Again, you want to do two contracts, then you make more money. You make $730, $740, your choice. Here's a great example of the last piece of the puzzle, Baidu. Kind of a combination of an ascending triangle, symmetrical triangle, earnings report out on the horizon, setting up, but this is where our axiom strangle scan, now I do have a scan that identifies these with all the criteria in them, identifies this well before the earnings. So we put on the position, it costs $7.33 to get in, 99 strike call, 78 strike put, beautiful, nice breakout. Now for those of you that may have been cynical saying, oh well, you showed nothing but downside breakouts and we know volatility goes up when they go down, that's why they made more money. Works just the same on an upward breakout. Stock breaks to the upside and our position made $737, little over 100% gain. Profit 100.1%. But watch what happens to Baidu. It consolidates again. And now you're thinking, well, this couldn't be better. A lot of people put on straddles right before earnings. It doesn't work. And here's why. Thinking that an earnings report's going to move the stock. Well, we all know earnings reports move the stocks, but if you don't understand how options are priced and how they work, this is what can happen to you. We move into another symmetrical triangle right before earnings, and you're thinking, we're going to double dip on this one. This is perfect. So we put on another one. $10.40 is the debit. Costs more. That should be a hint. Breaks out. And actually, the breakout on earnings was more point-wise than the breakout of our position earlier. But look what happened. Even the axiom strangle loses money. It loses $251. Why? How come that one lost 24% and the other one made 100% when the stock actually moved further price-wise? Here's the last piece of the puzzle, but a very important piece. Implied volatility. You cannot ignore it. Look where volatility was in the original position, the first one we did, the one that our axiom strangle scan identified. Volatility was really low. When the stock broke out, volatility went up with it on the breakout. That's why I was telling you that volatility doesn't always go down when a stock breaks, not if it breaks to the upside, not if it breaks strongly enough. Volatility will go with it. But what happens to implied volatility right before earnings? We're not the only ones that know that earnings reports move stocks. Volatility gets pumped into the options. You're paying more. You saw $7.30 for the first one, $10.40 for the next one. Why? More volatility. But then look what happens to the applied volatility the second the earnings report is announced. Boom, it tanks. Even though the stock made a huge move price-wise, it tanked and we lost money. Less cost, faster profits due to the acceleration of delta. Pretty amazing stuff. I think you would agree. And we have a scan that identifies these, taking into account the pattern, where it is in the formation as far as when is it about to break out. They don't always break right away, but quite often they do. We'll only put them on if the implied volatility is low and we get explosive moves. Now that equity curve that I showed you is dealing with a period of time where the VIX has been unusually low. Very little volatility in the market to move stocks. We don't need it. The pattern creates its own volatility. But now, where are we? Now the VIX has moved higher. It's the ideal scenario. Anytime the VIX is below 25, this is a great strategy. It's perfect right now because now the market is helping move the stocks in addition to the patterns. So we've been able to generate those kind of returns without the help of the market because the volatility has been so low. We have to look a little harder to find individual securities with low volatility, but they're out there. Just because the VIX is up doesn't mean the implied volatility of every individual stock is up. And in fact, when they go through a consolidation pattern, the volatility comes down. So we find the patterns, find the low volatility. We have the help of the market. That's why I said in the very beginning, you couldn't have a better time than right now to take advantage of this. It's amazing. I think you would agree, if nothing more, it's kind of a cool strategy. So how do we learn more? Well, you can go to our website, click over on the upper right-hand corner where it says register. Doesn't cost you anything. We can register for, I have a weekly outlook where I give you, we talk about clear, concise market analysis. We don't have ulterior motives. We're not investment managers. We don't need to sit there and jawbone and talk about how the market's going to go up because the economy is wonderful. I'll tell you what's really going on in the economy, and I've been alerting our subscribers for weeks, if not months, that things are not going great in the economy, and we're getting ready for a pullback, and we're getting ready for more volatility in the market, and that's exactly what has happened. So you can register on the website, get the free outlook every Sunday, cover what happened the previous week, tell you what's about to happen over the next week. If you want to take us a look, give us a test drive, you can do that. Or if you want to become a subscriber, there you can go and register there. We have several different subscriptions to choose from, but the Axiom Strangle is the one that I highlighted for you today. So that's basically it. Pretty much on time, which is great for me because I tend to get long-winded. So appreciate your attention. Look forward to talking to you more. I thought I'd do daily updates for our subscribers every single day, tell them what happened in the market today in a real manner, and we go over each one of our alert positions, where they stand each and every day. That's for subscribers, but again, you can register for the website for free and get the weekly outlook every Sunday. Doesn't cost you anything, whichever you'd prefer. If you want to give us a try, do that. But you can peruse through the website, see the different types of subscriptions that we have if you're interested. If you have a question, you can email us at support@optionaxiom.com. support@optionaxiom.com. Website is simply optionaxiom.com. Thank you so much for your attention. Enjoy the rest of the seminar presentations.